Hello everyone, hope you all are doing well. Welcome to today's class. Today we will go over A-Level Accounting 9706 October-November 2024 exam. This is the paper variant 1-1 and this is MCQ paper, right? So this paper is of 1 hour and consists of 30 questions, meaning you have on average 2 minutes per questions. So let's get started. I'll add timestamps to each question so you can navigate to whatever question that you want to jump to if you are struggling with that. But the best way to do this is, by practicing the exam itself and then following along or, just playing the video in the background. And if you get stuck, you can just refer to the video. So let's get started. This is the first question and it pertains to a bank overdraft. So, what is a bank overdraft basically? A bank overdraft is sort of like a credit card but for a business. This is the analogy I give to my students. So, in a credit card, you can use as much as you want up to the defined limit of the credit card itself. And the bank overdraft is similar in nature. You can use as much as you want by staying in while staying inside the limits, and you have to pay it back quickly, just like a credit card. So, keeping that in mind, which statements are correct? Is it a long term finance? No, it's not. Is it a short term finance? Yes, it is. Is it of a fixed amount? No. Like a conventional loan, it is not of a fixed amount. And is it of a variable amount up to a limit? Yes, it is true. So, which option is correct? The option D is correct, which states that statements 2 and 4 are the correct ones. Moving on, the next question pertains to Marcus buying a non current asset. Instead of paying in full, he decided to pay in installments over the next 6 months. Each detail is important, so try to highlight, try to underline whatever is convenient for you. So, what was the effect of Marcus's decision during the next 6 months? During the next 6 months. So, what will happen if Marcus does not pay cash upfront? What would happen is that he will not have to pay a lot of cash, and which means that his liquidity will not be affected by it as much as if he would, in the case if he actually paid that much money in one go. So, what's going to happen? Yeah, what would happen is that his loans or bank OD, whichever he prefers, would be lower. All right, his liquidity would be higher. All right, but his current liabilities would also be higher, and his non-current liabilities NCL would not be affected. So keeping that in mind, let's jump to the options. Here the first one is bank overdraft was lower. Yes, this is the correct answer. However, we'll still discuss the other options as to why they were incorrect. So the second option states that the current ratio was higher. As you know, the current ratios formula is current assets divided by current liabilities. So in this case, as I told you, that current liabilities increased. So if the current liabilities increased, the current ratio decreased because they have an inverse relation, right? So because the current liabilities increased, the current ratio decreased. So the second option is incorrect. What about the third one? Liquidity was worse. No, it was not worse because Marcus did not pay a lot of money upfront. He had a lot of money in the bank, but his current liabilities were higher, meaning he was bound to pay them in the future. But for now, his liquidity was safe. It was not worse. And the last one, non-current liabilities were greater because he is going to pay in the next 6 months, not 1 year, not 2 year, in the next 6 months. This pertains to current liabilities. So no, his non-current liabilities were not affected at all. They were not greater. So the correct answer is A. All right. Moving on. A business sells a non-current asset for cash. Again, each detail is important. The disposal account includes entries for the cost of the asset and the sales proceeds. Which books of prime entry are used? So let's discuss each one. So what about the cost of the asset? The cost of the asset because it is not bought to be resold, or it is not bought to be processed and then sold later on, it will not go in the purchases journal, right? It will not go there because it's not bought to be resold. So, however, when removing the non-current asset, the entry would be a journal entry, and it would go through the general journal. Why? I'll show you why. General journal. Because the debit entry would be the disposal account, which would be debited, or the cash account, whichever you prefer, and the credited amount would be the current asset, sorry, non-current asset, the asset account. This means that the entry would go through the general journal. So in this case, only this option contains the general journal. But for the sake of it, let's discuss the sales proceeds one as well. And why would the sales proceed not go through the general journal or the sales journal? Because the asset is sold for cash. It is directly sold for cash. It is not sold on credit. So it's not going to go in the general journal. However, it is going into, sorry about this. However, it is going to go in the cash book. Why is that? Because the sales journal is used to record sales, credit sales of inventory or trading stock. Sales journal (SJ) for credit sales of inventory, right? But in this case, we're selling non-current asset, and it is not sold on credit, it is sold on cash. So the debit entry would be cash book, and only C has both of these options as correct. So C is the correct answer. Moving on, this is question number 4. The owner of a business received an order from a customer on the last day of the financial year. Order received on the last day of the financial year, 31st December, and dispatched the goods on the same day. The goods were invoiced to the customer a few days later on 3rd January. Invoiced on 3rd January. Which accounting concept should be applied when deciding whether to record the sale on 31st December or 3rd January? So, when doing this question, first tell me whether the sale should be recorded on 31st December or 3rd January. Let's just, make a small timeline. In this case, the order received was on 31st December. It was dispatched also on 31st December. However, it was invoiced on 3rd January. Right? So, what's going to happen now? A sale is recorded when it is made. A sale is recorded when the owner of the business or the business itself fulfills its obligations. In this case, the obligation was to dispatch the goods, right? They were not providing a service, they were selling goods. So when the goods were dispatched on 31st December, on that date, the obligation was completed, and because of that, the sale should be recorded on 31st December. So, which concept did we use when discussing this to decide on which date the sale should have been recorded? Was it consistency? Consistency talks about the consistency of, in this case, it talks about whether the accounting method is applied consistently, right? So, in this case, did we use this concept? No, we did not use this concept. What about objectivity? Objectivity means that the accounts should be based on verifiable evidence. and the owner has verifiable evidence. What verifiable evidence does he have? He has the invoice. He also might have a dispatch note on 30 that was made on 31st December. So this is also incorrect. What about prudence? Many students might think that it was prudence, however, it was not. Why? Because prudence refers to do not overstate assets or profits, and that recorded losses should be recorded as seen as foreseeable, right? And the gains should be recorded only when they are certain. In this case, that is not true. That is not the metric that we are using to check whether the sale should be recorded on 31st December or 3rd January. Why? Because in this case, we have dispatched the goods. The goods have been dispatched, and the issue is not about recording this, is not about whether we will receive the cash or not, because there is no indication of us not receiving the cash. There is no indication of us not receiving the money. So prudence is not applicable here. So what about realization? Realization means that revenue should be recorded when it is earned. I mean, it's usually done when goods are delivered or services are performed. In this case, the goods have been dispatched. So the sale should be realized, and that means that this is the correct answer. All right. So moving on, this is the fifth question. Details regarding the purchase of a non-current asset are as follows. This is the cost, this is the expected residual value, installation cost, cost of inventory, and the question is which amount was recorded as capital expenditure. This one is quite simple. You should know that the cost of the new machine, it is obviously included in capital expenditure, capex. What about the expected residual value? No, the expected residual value will not be included, because usually at your level, when expected residual value is used, it is used to calculate depreciation, right? The cost of the asset minus the expected residual value divided by the useful life of the asset, that gives us the depreciation. So in this case, that is not applicable because we are looking for capex, right? So this is not applicable. What about the installation cost of the new machine? Yes, it will be included. Why? Because the installation cost is necessary to put the asset into use. So it will be included in the capex. What about the cost of inventory? Some students might argue that inventory used in the machine is also necessary to put it into use. However, the inventory in this case is and always will be recorded in the inventory account. It is not a part of capital expenditure. It is a current asset, so it will not be included here. So the correct answer is 20,000 plus 3,000, which means 23,000. The correct answer is C. Moving on, a depreciated non-current asset is revalued upwards. What is the effect of this? In this case, the upward evaluation, it will increase the capital reserve. It will increase the capital reserve. Why? Because it is a non-distributable profit. It is a non-distributable reserve. And if it is non-distributable, it will not go into the revenue reserve, which is only reserved for what? Which is reserved for only trading profits. So because we did not get any profits out of this, this was a one-off event, most likely. This was a one-off event. So that does not mean that this should go into the revenue reserve. However, it will go into the capital reserve and increase it because there was an increase in the fair value of the asset. This will increase the revaluation reserve. Hence, the correct answer is that it increases the capital reserve. However, it has no effect on the revenue reserve. So the correct answer is B. All right. In question number 7, it states a business depreciates its non-current assets at 20% using the straight line method. Depreciation is calculated on a time basis in the year of acquisition and disposal, which means that if it was, for example, disposed on 30 June, and the year end was 31st December, that means that it was used only for 6 months, and we will only record depreciation for 6 months, right? So let's get to this. Non-current assets at cost 31st December the previous year, or the opening in this year, was 200,000. The purchase of machinery on 1st January, the first date, was 50,000, and the disposal of machinery on 30 September was 40,000. And the non-current assets at cost on 31st December of the current year was 210,000, which means this is the closing. All right. So what does the question ask? It asks, what is the depreciation charge for the non-current assets for the current year ended 31st December? So how can we calculate this? We'll calculate this by breaking each and everything into three parts. So this includes the new asset, but does not include the old asset, the one that was sold, right? So this was 210,000. We'll just deduct 50,000 from this, and these are the assets that were outstanding at the opening, right? So what about the 50,000? Is it not going to be depreciated? Yes, it is going to be depreciated, but we'll just do it separately. So whenever a new question arises in which it is not bought on 1st January, for example, if it was bought on 1st April, you can do that. So it was 50,000, the new asset. These are the outstanding ones, and another one is for closing asset. Sorry, the disposed asset. So the new asset was 50,000, the disposed asset was 40,000. So what is their depreciation rate? I'll just write rate here. It was 20% for everything, so 20% here, 20% here. Let's write about this, 20% here and 20% here, right? And now, what was the time period? This was used for 12 months because they were outstanding at opening and they are outstanding at year end. So 12 months out of 12 months, right? And then what about this? What about the new asset? It was bought on 1st January, so it was also used for 12 months. So 12 by 12. What about the disposed asset? It was used till 30 September, which means that it was used only for 9 months. So 9 divided by 12. All right. So let's find the depreciation, which would be 160,000 multiplied by 20% multiplied by 12 divided by 12, which comes out to 32,000. All right. So what about this? 50,000 into 20% into 12 divided by 12. This comes out to 10,000. And what about this? 40,000 into 20% into 9 by 12. This comes out to 6,000. So add all these up. This gives us 32 plus 10, 42 plus 6, 48. 48,000. This is the correct answer, and this is the option number B. This is the correct answer. All right. I hope you understood that one. All right. Moving forward. The following errors were found after a suspense account was opened. Errors. All right. The question asks which errors would be entered in the suspense account. So tell me, which errors are actually entered into the suspense account? The errors that have only one leg, that affect only one side of the entire ledger and which cause an imbalance in the trial balance itself, only they are corrected using the suspense account. Let me give you an example. What about the first one? A cash purchase of goods for resale for $450 had been completely omitted from the books, meaning it was never recorded in the books in the first place. So what is the entry going to be? It's probably debit goods, inventory, whatever you call it, credit, cash. Cash book, the cash account, right? Because it was bought with cash. See? So there was no need for a suspense account. What about the second one? A payment for electricity was debited in the electricity account as $2,500 instead of $5,200, meaning the payment was made for $5,200. However, it was recorded as $2,500. What effect does that have? That means that the entry made was more like this. The entry was debit, payment for electricity, so electricity expense. Sorry about this. Debited was electricity expense by 2,500, and credited was cash, because it was a payment. So cash with $5,200. So there was a difference of $2,700, which was uncorrected. This means that when the trial balance is made at year end, the difference between this and that, for example, if this was 100,000, the debit side, the credit side would be 102,700. This means that there was an error. So what? We're going to make a suspense account. The suspense account is going to account for the $2,700 that were missing. So debited would be suspense account, the sus account. So this would be $2,700, right? So this would need an entry in the suspense account. So the option number 2 will be needed for entering in the suspense account. What about option number 3? Discount allowed of $50 had been debited to the discounts received account. Why is this? Is this supposed to be in a suspense account? Tell me. It was debited in the discounts received account. No, this needs a correction, but this does not need a entry in the suspense account. What about number 4? Number 4, motor repairs of $400 were credited to the motor vehicle at cost account. Does this need a suspense account entry? Yes, it does. So the correct answer is option 2 and 4, which is option number C. All right. So moving on. A business is preparing a bank reconciliation statement. The following information is available. What is the debit balance on the bank statement? So there are unclear lodgements and unpresented checks. And the cash book balance is this 7,650. So let's just make the recon. This is quite simple. We'll just solve it right now. So there is no issue, right? So this would be 7,650, the credit balance right here, right? So, and then the uncleared lodgements, I'm just going to write them as UL. They're going to be 3450, right? And the unpresented checks, they're going to be 2950. They're going to be they're going to be subtracted from this entire balance, which gives us the total amount of 8,150, which is the third option. All right. Okay. So tell me, for question number 10, which sources of information will be required to prepare a sales ledger control account? The sales ledger control account, or the SLCA, it requires data from the cash book, which are the receipts, right? The cash book contains the receipts, from the general journal, which contains the adjustments, and the sales and sales return journal. Obviously, these will be included. So all three are needed to prepare the sales ledger control account, which means that all three are correct. So the answer is A. All right, moving on to question number 11. The opening balance on a purchases ledger account control account purchases ledger control account was 18,400. This was the opening balance. The following errors or omissions were then discovered. What was the corrected balance on the purchases ledger control account? So we'll review each error and then we'll decide what to do with it. So the first one is a supplier's invoice for $860 had been entered as $680 in the purchases journal. This means that they are understated by how much? 860 minus, sorry about this, 860 minus 180, sorry, 680, which means that they are understated by $180. So how will we rectify this? The $180 will be adjusted to the PLCA, the purchases ledger control account, and added into the total balance. I'll just write the total balance here. 18,400 plus, just write it a bit more neater, 18,400 plus 180. All right, now over the second thing, the purchases an item for $250 in the purchases returns journal had been credited to the supplier's account. It had been credited to the supplier's personal account, which means that this is an individual ledger error. This is not, this error should not be reflected in the PLCA. So it will have no effect on our purchases ledger control account. All right, hope you got this one. This error pertained to an individual ledger, which was, the supplier's ledger. It was not a part of the purchases ledger control account. So this will have no effect on the total control account. So moving on, the discounts received of $400 had been credited to the purchases ledger control account. This, when we receive a discount, do we debit it or credit it in the purchases account? We debit it in the purchases account. So this is incorrect. It should have been debited. So the balance existing there was of 400. All right, the balance here, just going to make this better. The balance outstanding here of 400 was incorrect. So to offset this, we put 400 here. But that's not it. To rectify this, we will have to put another 400, because the first 400 only had the effect of, canceling out each other. The correct balance was 400, so we debit it again, which means that we will add $800 to this entire thing. All right, hope you got this one. Just going to move this a bit to the side. All right, so now the last one. It had been agreed to set off $150 owing to a customer against their account in the sales ledger. However, no entries had been made to the sales or the purchases ledger control accounts. So to correct this, we'll just make an entry of, sorry about this one. This should have been minus 800. We'll subtract this. This will decrease, the discount would decrease the purchases ledger control account. Sorry about that. And the last one, no entries had been made to the sales or purchases ledger control account. So to, the correct entry would be to decrease both sales and the purchases accounts. So this would be minus 150. Sorry, the correct entry would have been to decrease the purchases ledger account. So the correct entry would be to subtract minus 150. So the correct answer of this is $17,630, which is, I think, the first option, answer A. All right. So moving on, this is a theoretical question. What is the purpose of financial statements? So I think you can do that. What is the purpose of financial statements? Is it to aid the managers in running the business? I mean, yes, it is. Is it to allow the owner to take drawings? No, it's not exactly that. It is to reflect the correct image of the accounts. And is it to ensure a profit is made? No. Again, it is to show how the business is running and how we can improve it. And the last one, to ensure accuracy of the double entry. No, it is not also that either. All right. So the correct answer is the first one, to aid the managers in running the business. Moving on to the 13th question. A business owner provided the following information at the end of his first year of trading. The closing inventory is $15,000. The total payments to the suppliers is $60,000. The amount owed to suppliers is $5,000, and the total receipts from customers is $85,000, and the amount owed by customers is $10,000. So what is the question exactly? What was the gross profit for the year? So how can we tackle this? What is the formula for gross profit? It is sales minus cost of sales, right? Sales minus cost of sales. So do we have the sales and do we have the cost of sales? Not exactly, but we're going to find them out. So total receipts from customers and amount owed by customer means that we made sales worth these. So these would be the sales, right? Because you'll only receive money if you sell something, and the only way a customer is going to owe you money is because they bought something from you. So these are the sales. What about these? Total payments to suppliers and amount owing to suppliers. For the same logic, you will not owe money or you will not pay money unless you bought something. So these are the purchases, right? And this is the closing inventory. So using these two, we can find the cost of sales, and we already have the sales. So let's get to it. How can we find the cost of sales in this case? In this case, let's just find the cost of sales first. So the formula for cost of sales is, sorry about this. So the formula for cost of sales would be to opening inventory plus purchases minus closing inventory, right? What's the opening inventory? 0. How do we know that? Because it was his first year of trading, right? It was his first year of trading, so he did not have any prior inventory. So the opening inventory is 0, and the purchases are 60,000 here and 55,000 here. So just put these in brackets, 60,000 plus 5,000, and we'll subtract these from these the closing inventory, which is of 15,000. This gives us 50,000. This is the cost of sale. These are the cost of sales. And what are the sales? They are 85,000 plus 10,000. 85,000 plus 10,000. This comes out to be 95,000. So what's the formula for gross profit? It's sales minus cost of sales. In this case, it's 95,000 minus 50,000, which gives us 45,000. This is the correct answer. And which option is this? It's option number D. This is the correct option. All right. So moving on. Question number 14. Lou had the following capital account balances. End of year 1, 35,700, end of year 2, 63,400. And during year 2, the following took place: cash drawings of $33,000 and a personal motor vehicle introduced to the business at a value of $24,500. Expenses for the year Expenses for the year include a payment of rent for $10,000, of which 40% was for Lou's personal use. Of this $10,000, 4,000 was for Lou, right? I hope I'm pronouncing this name all right. Okay, so what was his profit for year two? Hmm. What was his profit for year two? The profit would be calculated like this. Sorry about this. Yeah, so the profit would be the closing capital minus the opening capital plus the drawings minus the capital introduced minus the personal expenses. In this case, let's just find what these are. This is the formula you should, use for this question. What's the closing capital? It's $63,400 minus the opening capital, which was $45,700, plus the drawings, which were $33,000 here, $33,000 here, and plus the drawings in the business, which were, sorry, and minus the capital introduced, which was $24,500. This capital was in the form of a car, right? Capital introduced. This was in the form of a car, and minus any personal expenses made by Lou. In this case, it was 40% of the $10,000, which means it was $4,000. So profit would be $30,200. This is the correct profit. I'll try to explain this one better. The profit would be the closing capital mentioned here and minus the opening capital, the difference between these two, and then we would add the drawings during the year, which would be taken out of the profit, which would be taken out of the capital account balances, right? So $33,000 would be added back to the profit, to in the computation of the profit, and then personal motor vehicle introduced, which was $24,500, meaning this was contributed to the business by Lou. So this will also be deducted from the profit calculation because it was not profit, it was actually capital introduced. And expenses for the year include a payment of $4,000 for Lou only, right? The $6,000 was for the business. However, the $4,000 was for Lou himself, so it would be included in the personal expense, and it would be minus subtracted from the calculation of the profit, which would give us $30,200. This is the last question before we take a small break. This is question number 15. A business maintains an allowance for irrevocable debts of 2% of trade receivables. At the beginning of the financial year on 1 January, the trade receivables total was $48,000, meaning 2% of this would be how much? $960, right? And at the end of the financial year on 31st December, the trade receivables total was $37,000. In this case, 2% would be $740. When the business owner prepared the statement of profit or loss for the year ended 31st December, an irrevocable debt of $1,600, which had occurred during the year, had not been written off. It had not been written off, and it had occurred during the year. No adjustment had been made to deal with the allowance for irrevocable debts at 31st December. No adjustment had been made, by which amount was the profit for the year overstated. So, profit is in this case is overstated due to a bad debt of 1600, the irrevocable debt of 1600 mentioned here. All right, the new allowance would be $740 that I mentioned here, and the previous allowance was $960. So the decrease itself is from 960 to 740. The decrease is actually of $220. So the total, please give me a second. Sorry about that. Yeah, sorry. Where were we? Let's go over this one again. So the balance of the irrevocable debts at the start of the year were $960, and at the end of the year it was $740, which means there was a decrease by $220. However, the closing trade receivable was of a balance of $37,000, and it had not included the impact of the irrevocable debt. So, what will happen now? The $37,000 includes the balance of $1,600 that should have been written off, which means that this balance should be $35,400. This is the correct closing receivable balance, right? This is the correct closing receivable balance. And of this, 2% should be the provision, which means 2% would be 708. So, taking account of that, 960, which was the original balance, minus 708, which should be the correct balance of the provision at the year end. The difference was $252. So this was not accounted for. However, the $1,600 was also not accounted for. So the net impact would be increase it by $1,600 and decrease it by $252, which would give us the net impact of $1,348. Right? I hope you understand this. This is option number B. I'll go over this one more time, and I'm going to go over it on the side here so that you can understand it a bit better. Right now, with the information given above, it was $960 at opening, and closing was $740, which would give us a decrease of $220. However, this was incorrect. So what would be the correct thing? The closing was actually $708. And why was it $708? Because it should be the closing balance, which was $37,000, which does not include the impact of the bad debt, which was 1600, right? So it would be decreased by 1600. 37,000 minus 1600 gives us 35,400, which would then be multiplied by 2% to give us 708. And then 960 minus 708 means that the balance would decrease by $252. So the profit is understated by $252, right? And then, however, $1,600 had also not been recorded, which means that if they were recorded, the profit would have been decreased by $1,600, which means that the profit is overstated by $1,600. So taking the net impact of $1,600 and $252, the answer should have been $1,348, meaning the profit was overstated by $1,348. All right, I hope you understood this one. Let's take a short break and then I'll get back to the video. All right, guys, moving on. Let's discuss this one. Anne and Margaret have formed a partnership, but they have not made a partnership agreement. Which statement is correct for this situation? All right. So, any loan made to the partnership by a partner will carry uh, interest at the rate of 5% per annum. The second one is interest will be charged on drawings at the rate of 5% per annum. Option C is partners will be entitled to interest on capital at the rate of 5% per annum, entitled to interest on capital. All right. And for D, it is partners will be entitled to salaries in proportion to the capital contributed. Which one is correct? As you read, as per the Partnership Act of 1980, sorry, 1890, Partnership Act of 1890, the profits and losses are shared equally. So this one is incorrect, right? Sorry about this. This one, option D, is incorrect. Salaries and the salaries are not allowed unless they are agreed upon. All right. And interest on capital is not allowed as well. So option C is also incorrect. And the on drawings, it is also not allowed. So, however, loans that are made are all will carry an interest of 5% per annum because there is no partnership agreement. However, the Partnership Act mandates that any loan will carry an interest of 5% per annum. So the first one is correct. All right. Question 17. P and Q, who are partners in this case, by the looks of it, they are the partners in a partnership sharing profits. They are in a partnership sharing profits and losses equally. They are sharing them equally. All right. This is very important. So the following information is available in respect of P. The current account credit balance at the start of the year, this is for P only, it is 2150. The share of asset revaluation is 10,000 and the drawings are 10,200. This is only for P. This is not in respect of the partnership itself. However, the total partnership profit was 130,000 for the year, and the partnership salaries availed by P were $20,000, and the partnership salaries availed by Q were $30,000. So, what was the balance on the current account of P at the end of the year? So, how are we going to solve this? Hmm? We'll just do the opening balance of P was 20,150, right? And then the revaluation gain will be added. I'm just going to name it revaluation gain, just RG, right? It was $10,000. This will be added, and the drawings would be deducted. These are 10,200. These will be deducted. All right. So now what? What will we do about the rest? The salaries and the profit share, the treatment of them would be like this. The salaries and the share of profit are dealt with in the appropriation account. You know, so they are not entered into the current current account. So in this case, what is going to happen is that the salaries will be deducted from the profit. So the profit was $130,000, and the salaries of $20,000 and $30,000 would be deducted. So the profit remaining is $80,000. This profit itself would be, equally divided between the two. So what's going to happen? What's going to happen is that the amount that will be divided, that will be for P, will be 40,000 for P. So the share of profit is $40,000. However, we will not ignore the salary that was availed by P. So the salary availed by P would be of $20,000. And when we add all these, this would be 2150 plus 10,000, 3150 minus 200. This would be 9,950, and plus 40,000 and 20,000. This would be $69,950. This would give us the total of B. So the correct answer in this case is B. Going over it once more, the share of profit, these are exclusively for P. However, these are for both P and Q. So the profit would be $80,000, which would be uh, computed after subtracting the salaries of both P and Q, which were the total of $50,000. The remaining profit was $80,000. We'll divide that 80,000 equally, because the question says that the profits and losses are shared equally in the first line, right? So then $40,000 will be left, and the salary of P will also be $20,000. So it will be $69,950. That's the correct answer. All right. Moving on, let's go to question number 8. Which statements, multiple statements, are correct? Right. So let's go over each one. Capital reserves arise from normal trading activities. No, capital reserves do not arise from normal trading. They come from non-trading items. Non-trading items. Like what? Like revaluation surplus or share premium. Right. So this is incorrect. Capital reserves can be used to pay dividends. Again, like I mentioned in an example we did before, they are non-distributable profits. They cannot be distributed. Non-distributable profits. So no dividends can be paid from these, right? So this is also incorrect. Revenue reserves may be used when bonus shares are issued. Yes, revenue reserves like retained earnings can be used to issue bonus shares. So this is correct. And the last one, revenue reserves represent profits which have been realized. Yes, this is true. And these profits can be used for dividends. For dividends. So this is also correct. So the correct answer is option number C, which is statements 3 and 4. Moving on to 19. The following information is provided for a company for the financial year ended 31st March. The revenue was 7.2 million. The administrative expenses were 320,000. Finance costs were $150,000. Distribution costs were 250,000. Dividend paid was 60,000. There are no other expenses for this period, and the company adds a uniform markup of 25% on all goods sold. What was the profit from operations for the year ended 31st March? All right. So how are we going to use this? 25% on all goods mean that if the price was $100 for the goods, we'll sell them for 125. In this case, the revenue was 7.2 million, which means that if we divide this by 125%, this would give us, the cost of sales. And in this case, if we do that, if we divide by 125% or 1.25, this would give us 5 points. This would give us 5,760,000. This is our cost of sales. All right, this is the cost of sales. So the gross profit would be the cost of sales, sales minus the cost of sales, which would be of 1,440,000. All right, what next? The profit, we need to find the profit from operations, the operations only. So the profit from operations includes only admin expenses and the distribution costs. It does not include the finance costs or the dividend paid. So we'll only subtract these two, the admin expenses and the distribution costs. We'll only subtract these from the gross profit. So 320,000 minus, and the distribution costs, which are 250,000. This would give us the answer of $870,000. This is the profit from operations. All right, this is answer. So the option number B. This is the correct answer. All right. Okay. Moving on to question number 20. Which statement is a limitation on of accounting ratios? They do not aid comparison with the business's past performance. This is incorrect. This is the first thing that we're taught, that they do aid the comparison with the business's past performance. They're actually used for that. Okay, so next, they do not help with future decision making. Of course, they help. They tell us what we need to improve so that we can make future decision making. They have their limitations, but they can help us with that. They do not help with inter-firm comparisons. Of course, they do. We're also taught this beforehand. All right. So this is also incorrect. They do not take account of qualitative factors. Yes, that is true. But what are qualitative factors? Qualitative factors are, brand strength, customer loyalty, or, staff morale, stuff like that. Things that are related to, people's feelings that cannot be quantified, can't be quantified or measured, right? So that is a limitation. So the correct answer is D. All right. So the next one is question number 21. Let's do this. A business provided the following information at the end of a financial period. The total purchases for the period were this, cash purchases were this, trade payables at the start were this, and the trade payables at the end were these. So 700,000, 200,000, 80,000, and 60,000. What is the trade payable turnover in days? So when we do this, we're gonna do is the how much balance is actually on credit. What are the credit purchases? So in this case, the total purchases were 700,000. The total purchases were 700,000, and the cash purchases were 200,000, which means the remaining balance of 500,000 were what? They were credit purchases, right? Because purchases can only be made on cash or credit. So if we take away the cash purchases, the only thing left is credit purchases. This is of $500,000. All right. So the trade payables at the start were sorry about this. The the trade payables at the start were trade payables at the start were $80,000, and at the end they were $60,000. So the average of them would be, by adding them and dividing them with 2, which would be average 140,000 divided by 2. This would give us $70,000. This is the average. So the trade payable turnover days formula. This would be 70,000 divided by 500,000 multiplied by the number of days in a year, which gives us to be 51.1 days, or if you round it up, it would be 52 days. 70 divided by 500 into 365, that would be, just round it up to 52. That's the turnover days, right? I hope you got this one. All right, the next one, question number 52. Which cost will increase as production decreases? Will it be fixed cost per unit? Yes, because fixed costs remain the same no matter the production. So if the number of units increase, the FC, the fixed cost per unit, will decrease. So this is correct. How about the second one? Total fixed costs. No, they will not be affected as production decreases. And if about this would be vice versa. All right. So the total variable cost, no, the variable cost will not increase as production decreases because they are directly linked to to the production itself. So this will not change either. And what about the variable cost per unit? Again, this will not decrease as this will not increase as the production decreases. So the only correct answer is one. So the correct option is option number A. Moving on to question number 23. This relates to equipment, the lease cost of the equipment. So X Limited leases a piece of equipment to perform quality inspections. This costs $800,000 per annum plus 2%, $2 for each inspection performed. Right? An inspection is performed on every 10th item produced. Production is $120,000, 128,000 units per year. And which type of cost is incurred, and what is the annual cost? So what is the fixed cost? It is 8,000 per year, right? And the variable cost is $2 per inspection, not item, per inspection. So how many inspections are there? The total number of inspections would be, if the total production is 120,000, it would be on every 10th item, which means if you divide this by 10, the total inspections would be 12,000, right? So the cost of this would be 12,000 into $2. This would be $24,000 per year, right? So the variable cost would be $24,000. This is the variable cost. However, the fixed cost would be, as we discussed above, $8,000 per year fixed cost. So the total cost would be, $32,000, right? So what type of cost is incurred and what is the annual cost? We computed the annual cost to be, 32,000. So only this and this are correct, the rest are incorrect. So will it be semi variable or will it be stepped? It will not be stepped because it is incurring in equal installments. It is incurring after every 10th item, right? So it will be semi variable, it will not be stepped. So the correct answer is not this, it's this. So the correct answer is B. All right. So now question number 24. This is about the FCO, or the average weighted cost. A business uses the weighted average cost method of inventory valuation. During March, the following transactions took place. On 1st March, opening inventory were 200 units at $6 per unit. On 14th March, received 300 units at $6.50 per unit, and on 20 March, it would be 250 units to production at $700 per unit, and received 100 units at $6.70 per unit. So what is the value of inventory at 31st March? The best thing would be to do this on Excel. So there would be a table, so it would help you out. But of course, you guys will have to do it on pen and paper. So let's just do it on Excel, so it's easier for you. All right, guys, we're back. Now let's look at this. All right, this was the question. On 1st March, we had 200 units valued at $6 per unit. So we noted that down here, that on opening on 1st March, we had 200 units of $6 each, which meant that the total cost of the units were $1,200. All right. And on 14th March, we received 300 further units at $6.50 per unit, $6.50 per unit, which meant that 300 units on 14 March at $6.5, which means that the cost of these units were $1,950. All right. Now what? And then on 20th March, we issued 250 units further for production at $7 per unit, which meant that the units went away from us. They should be subtracted from the total balance. which means that they were issued on 20th March, 250 units, and the cost of these units were $6.30. Sorry, $7. It was $7, which meant that this cost was $1,750. All right, and then further we received 100 units at $6.70 per unit. So this would be further included here, 100 units at $6.7. So what does the question want? It wants what is the value of inventory at 31st March, right? What is the value of inventory at 31st March? All right. So, but in doing this, what is going to happen is that for 250 units the price was $7, and for 100 units the price was $6.7, which means that the cost of the total units was $2,070. All right, and when we look at the answers we do not find 2070. Why is that? Because they are valued at weighted average cost method of inventory. All right, what does that mean? That means that whenever we get inventory, we include it into the cost of the inventory at the amount that it was received. However, whenever we issue the inventory, it is issued at the price at which it was being carried, at the average cost per unit that was being carried before that. So in this case, where is the mistake? Where is the mistake in this case? It's here, right? Because we're issuing it at $7, which was mentioned here on 20th March, where that we issued 250 units to production at $7 per unit. However, we will not take into consideration the $7. Instead, we will take into consideration the average cost per unit. So how do we get that? We have computed it over here. So the total units at the start were 200 units, right, which were mentioned here, and then the total cost was $1,200, which we can see we got from multiplying the cost of the cost per unit and the total units that was outstanding, and the average cost per unit was then $6 back then, right? And for the 300 units that we received on 14th March, it was the cost that we incurred was $1,950, which was computed by multiplying 300 with $6.5. All right, and then the total units that were outstanding were 500, which was because the opening was $200 as mentioned above, and to the left you will see that 300 units were received, so the total units were 500 units, and the total cost was the cost of the previous units plus the cost of the new units, which meant that the total cost was $3,150. And when we divided those, we got the average cost per unit to be $6.30. See here, $3,150 was the total price for the units that were bought and the opening units, and then we divided them by the total units and we got the average cost. However, here when we issued them, we will not take $7. Instead, we will take the amount that was the average cost per unit that was before that, which was $6.3. And when we do that, look, the amount changes. It goes from $1,750 to $1,575, which means that the total units remaining were 250 units. Their cost was $1,575, and their average cost per unit was $6.30. And then when we received the next batch of 100 units, which were valued at $6.70, we will take it at this amount and we will not take it at the average cost. So this would be $670, which means that when we add all these, which is done over here, this would come out to be $2,245, which is option number B. This is the correct answer in this case. I hope you understood this. If not, go back and watch this, and I hope that this will help you in the future. All right, moving on to question number 25. Amu provided the following information about a specific job to make jewelry for a wedding. All right, the cost of materials required is $10,000. Amu needs 10 hours at $125 per hour to design the jewelry, and her assistant needs 100 hours at $70 per hour to make the jewelry. Fixed overheads are absorbed at $50 per labor hour, and a markup of 20% is to be applied. What will be the price quoted for the job to make the jewelry for the wedding? All right, so let's get into it. The materials costed $10,000, right? Materials. We're just gonna move this a bit to the left, right? Okay. So, and then Amu wanted 10 hours for $125, which means Amu 10 into 125, which means 1,250. I'll just write 10 into, sorry about this. Just gonna move this a bit to the left. 10 into 125. And then her assistant wanted 100 hours at $70. So this would be 100 into 70, comes out to be $7,000, which means the total labor itself was 8,250. All right, labor. This was the labor cost. All right, and then the fixed overheads will be as follows. They will be absorbed at $50 per labor hour. So the total labor that was needed was 10 plus 100, which means 110. So 50 fixed overhead. I'm just going to write that as FOH for labor. This would be, I'm sorry, right, labor. This would be 110 into 50, which would come out to be $5,500. All right. So the total cost would be 10,000 plus 8,250 plus 5,500, which comes out to be $23,750. This is the cost. This is what? This is the cost. And then we need to apply a further 20% markup. So 20% markup of what? 20%. This would so we would multiply this by 1.20 for the total price to be quoted, which would come out to be $28,500. This is the correct answer, which is option number D. All right, so moving on to question number 26. This is about absorption costing. Which statement about absorption costing is correct? So the first one, it aids the perfection of budgets. No, it is, that is marginal costing. It is not absorption costing that aids the preparation of budgets. So this is incorrect. This refers to marginal costing. All right, so what about B? It The B says it follows the matching or accruals concept. Yes, that is true, because it matches the fixed overheads to the units produced or units sold. So yes, it follows the matching or accruals concept. So this is correct, but we'll review the other ones as well. It is the best costing method for managerial decision making. No, again, marginal is better for decision making. This is not the best option for decision making. And D, it produces the same unit cost in the long run, whatever the output. That is not true. It depends on level of activity. On the level of activity. So this is also incorrect. So the correct answer is option number B. All right. So moving forward to question number 27. This refers to canteen costs. We'll take a short break here. Be back. All right, so moving forward, this question pertain to canteen costs of a business, right? So the canteen costs of a business have been apportioned to production departments 1 and 2. All right. The total canteen costs apportioned to production department 1 were $40,200. Of these, $3,900 could be attributed to a special function by production department 1. The remainder were apportioned on the basis of employee numbers, which were 15 for production department 1 and 10 for production department 2. What were the total canteen costs for the whole business? So for this question, the total costs that were apportioned were actually 40,200. I'm just going to go here for a bit. $40,200. All right. And out of this, 3,900 were only for Department 1, which means that the remaining amount of $36,300 was apportioned on basis of employees, right? Because the first one, the $3,900 was only for the Department 1. So the rest was on the basis of employees. So if Department 1 had 15 employees and Department 2 had 10 employees, the total employees were 25, right? And if we divide this by 36,300, what we'll do is in this case, we'll just, for Department 1, what we're going to do is 36,300 into 15 employees divided by total employees, which gives us the amount of $21,780. All right. And for Department 2, it would be the remaining amount of $14,520. All right. I apologize, I explained this a bit incorrectly, right? So this $36,300 was for only for the number of employees of Department 1, right? So for Department 2, what we're gonna do is we're gonna right. So in this case, we're going to divide 36,300 by 15 to get the per employee cost. So divide by 15 to get the cost per employee, which would come out to be $2,420 per employee. We will then multiply this amount by 10 to get the total cost for Department 2, which would come out to be $24,200 for Department 2. Now, to calculate the total cost of everything, we will add $36,300 for Canteen 1, the Department 1, one's employees, Department 1, and then 24,200 for Department 2 two's employees. However, there is also the additional cost of 3,900 for the party. This is also included in the costs of the whole canteen. So this would also be added, and when we add all these together, this comes out to be 36,300 plus 24,200 plus 3,900. This comes out to be $64,400, which is option number B. All right. Okay, so moving on to question number 28, we are, on the third last question. This is also a theoretical question. What is a limitation of marginal costing? So let's check all of these. Option A is contribution per unit varies with output. It does not vary per output in the marginal costing. It stays fixed per unit. So this is incorrect. What about answer B? Inventory valuations vary more than under absorption costing. No, inventory valuation under marginal costing is actually less volatile than absorption costing. So this is also incorrect. And for the third one, it can cause over or under recovery of overheads, and this only occurs in absorption costing, and not actually, you know, marginal costing. So this is also incorrect. And for option D, the division of costs into fixed and variable is difficult. And yes, it is true, because it is difficult to split costs into fixed and variable, you know, fixed and variable costs in practice for marginal costing. So this is the limitation, and this is the correct answer. Now, moving on to question number 29. A company has the following budgeted information for May, for the month of May. Selling price per unit was $180. Sorry, $120. Variable costs were $80. So the contribution margin was $40, and the total fixed costs were $56,500. The company is planning to buy a new machine which will reduce the variable cost by 20% and increase the fixed cost by 20%. So what is the change in break even sales volume? So for this, we will have to, calculate the break even before and after. So we've got the $40 contribution margin before buying the new machine, and when we, divide the number of the total fixed cost by the number of by the contribution margin itself, it would be as such. I'll just solve it so you can uh, you know uh, understand it. So how much would we have to earn per unit, net of, the variable cost, to break even with the fixed cost? So the actual formula would be, 120x, which x would be the sales volume, minus 80x minus 56,500. All right, and to get that, we need break even. So we're just going to move this here. It will be 40x equals to 56,500, which would give us, 1,400 units. This was the previous break sorry, previous break even volume. So to calculate the new one, what we will have to do is we will have to, increase the fixed costs by 20%, and we will have to decrease this by 20%. It says here, increase fixed cost by 20% and reduce the variable cost by 20%. So when we reduce 80 by 20%, we'll just make a new equation and solve it like that. So it would be 120x minus 80 into 80%, because 20% is reduced. So 80 into 80%, x minus 56,500 into 80%, sorry, 120%, because this was increased by 20%, equals to 0. To get the break even, this would come out to be 120x minus 64x minus, what would this be? This would be 67,200 equals to 0. So 120 minus 64, that comes out to be 56x equals to 67,200. And when we solve this for x, we would get 1200 units. So the new break even, new, just write it as break even volume would be this. So the break even sales volume would decrease from 1400 to 1200, giving us a change of a decrease of 200 units. So the answer A is correct in this case. All right, now moving on to question number 30. Why is cost volume profit analysis useful for management? Does it give a more accurate value for inventory? No, it does not. Does it help with long-term decision making? No, it doesn't. It actually helps with short-term decision making, and it makes it easier to identify which costs are fixed. Again, this is related to, the volume, so variable costs. So it does not help with fixed costs either, and it shows the effect on profit when certain changes occur. So yes, this one is correct, because it helps managers understand how changes in, costs, volume, and prices affect the profit. All right, so it is powerful for short-term planning and pricing decisions, and evaluating the impact of these changes in the operations. So yes, it shows the effect on profit when certain changes occur. So option D is correct. I hope you enjoyed the video, and I hope some explanations were helpful. I went into more detail than, than I would have preferred, but some questions required more deeper explanations than before. And if you want to see more videos like this, do comment, and I'll leave my contact at the end of the video. I hope you had fun. I hope this was helpful. And if you have any more questions, please feel free to contact me, and I'll get back to you. Thank you.